A very warm welcome to each one of you. And this is a crucial point in the market where we are coming out from a lot of headwinds. And now, with the quarterly numbers poised to be announced from next week onwards, there is a lot in store for the market as far as opportunities and at the same time risks also in the market are concerned. So without further ado, I'll just quickly begin with today's presentation. It will be in two parts. We'll discuss, share what we have prepared for today's event. And second is what is the view for the market in the next 6 months. So where do we see the markets towards the end of this year, and what could be an opportunity to enter into the markets? What levels would be those? And we'll be discussing a lot more on that direction. So we're discussing the post-crisis market opportunities. We've been through a lot of volatility over the last few weeks and months, and now the timing is right. Now, just to sort of recap a bit, Feb-March was a period when the war broke out. It was we all know the kind of damage that was done. Oil prices immediately spiked, and foreign investors pulled out 60,000 crores in a single month. Now, once the initial war shock was done, we were in the April to mid-June, where attempts were made to pull the event back, pull the war back, and there was truce. Nifty climbed back about 24,000 as hopes returned, and now that the tide has turned in the first week of July, oil prices are very much back to pre-war levels. India VIX is below 13. We are seeing recovery across the market. Not only Nifty, but especially the mid caps and small caps have recovered in a very big way. Now, the numbers that tell the whole story. So Nifty fell around 9% from its all-time high of 26,373. It was a combination of the oil shock and the aggressive FI selling that we saw in the cash as well as the derivative segment. Oil, if you were a commodity trader, there were ample opportunities to trade on the long side. In the crude, we saw a vertical rally happening in Brent oil as it peaked about $126 per barrel, and the net effect was 60,000 crores worth of equities was taken out from our equity markets. This was the biggest FI exit since COVID period. So since a long time, we saw this kind of a 9% fall plus a lot of cash being taken out from the market. Now, the full-time recovery happens, at 26,373, which is where the previous previous level of the high of the market was. The key breakout level is placed around 24,300. Now, a weekly close above this should confirm the rally, and we may see very much head towards these higher levels. Now, essentially, 23,000 has become a base for the market as far as the next few months are concerned. And as you can see in the graph, we have a projection where this is how we expect the markets to play out eventually. So a bit of volatility in the month of July is to be expected. We have the Q1 numbers coming up, and we expect the numbers to be negative. There will be earnings contraction. There could be a few shockers as well on the way. And what that translates into is there could be a period in the month of July where we see stocks correcting significantly. Even Nifty may get into a correction zone. But we believe that it is a very, very relatively smaller pain to have, considering that we've come out of 2 years of earnings contraction. We've seen so many ups and downs on the trade wars. We've seen the war thing. Now the Q1 shock maybe about 2 to 3% in terms of Nifty, which means around 500 to 750 points on the Nifty approximately. And in terms of stocks, it can be higher depending on which sector gets the most hit. Now, if we look at how the relief rally is positioned, now the FI aggression on the cash side has definitely gone down. So we are seeing a reduction in the sell figures by FIIs. We are seeing similar movement in the history was seen both in the 2003 war of Iraq, then it was 2022. Generally, it took about 6 to 9 months for the markets to recover completely. Now, our recovery has already, our relief has already happened. Probably we are into that phase where recovery may start. Whether it starts in July itself or it starts in August, time will tell. But so far the first ones to recover are financials. That includes banks as well. So we are seeing financial services stocks, banking stocks, whether it is private banks and even PSU banks to a great extent, they have recovered. We're seeing auto coming back firmly. We're seeing defense holding on very well, and pharma has been the star performing index. In the entire period, it was one index which did not correct much, and in fact, it has gone on to hit newer highs in this period. So these are the four sectors which are leading the market as of today, and this is where we are focusing on. And going ahead from here, in case any dip happens, in case the shock, the volatility shock, the Q1 shock that we are talking of happens in the month of July, these are the sectors where we have to top up or look for fresh investments for the next 6 months from here. Now, like I said, financials are the backbone of every recovery. We've seen such moves play out in the past. The bellwethers like ICICI Bank, HDFC Bank, SBI, they are the names. For example, ICICI Bank is trading very strongly on the charts. We're seeing Bank Nifty, above key moving averages. So a lot of alignment is happening on the financial space. We're still, far away, still not at the prehistoric levels, but there is the direction is in the right side as far as financials are concerned. Now, similarly, coming to auto and defense. Now, defense, as we all know, it's globally defense budgets have gone up. Even our domestic budget has gone up. It is at a record high. There is a price to pay for peace, and that peace eventually, that price eventually will be paid to the defense manufacturing. A lot of defense manufacturers in India are already operating at their peak. So, from an absolute money-making, wealth creation perspective, it may take time. But from a short-term tactical bet, short to medium-term tactical bet, this sector has played out well and is expected to remain positive. And like with the oil below $75 per barrel, the overall buyer sentiment is also improving in the auto space. We're seeing some rejig happening between ethanol and electric vehicles. Eventually, I think the sector is poised to do well. Last time we saw pent-up demand was in September last year when the GST rejig happened. We saw auto stocks take off in a big way, and now again that demand is expected to come back. A lot of it depends on the monsoon as well. A lot of it depends on how the agri demand sustains from here. Monsoons have been picking up, although they have been late, but they have been picking up. And over the next couple of weeks, if monsoon does its magic, it will have a positive impact on the agrarian economy, on the agricultural side. So we continue to remain strong on these four sectors, whereas IT is something which is continuously getting hit left, right, and center. In fact, bounce backs or any sort of attempts to recover have been sold into, and we feel that it's best to stay away from it unless and until there is a major fundamental change that happens as far as these IT companies operate. I think it's best to stay away from this sector at this point in time. We would want to have at least a few months of consolidation for it to call a bottom and a recovery to take place in the IT space. Until then, I think it's best to be a trader and keep on trading these moves as and when they come. Now, okay, so what the government and RBI have done and what does it mean for us? So we've had the repo rates being held unchanged in the last meeting that we had. The implicit decision was made on the 5th of June. Overall, the GDP forecast has been revised down. The inflation has gone up. So from a macro perspective, the next MPC meeting that we have in the first week of August, a lot of eyes would be on where the oil prices have gone, how the monsoon has played out, and overall the Q1 numbers that come in, Q1 GDP numbers that come in will be a key factor in making the overall decision on further rate cuts, whether they are possible or not. As far as policy moves are concerned, both the government and RBI are working together to bring stability, and the policy environment is supportive of recovery and not really fighting it. We've seen the defense budget, we've seen FI tax relief as well. The bond market, the FAR expansion, that was a positive development that brought a lot of money. And one thing which is not part of this presentation is there is possibility of a rejig happening at the ministry level. So we could have a new finance minister, we could have a lot of changes in the key leadership roles in the ministry across the country. That could play a major role in terms of changing the sentiment initially, and then eventually when the new people come into power, it will be interesting to see what kind of reforms do they bring in, what kind of strategy do they adopt, and that is something that markets would closely monitor as and when it happens. Now, the 5 things that tell us that the recovery is real. This presentation was made a few days back, but a lot of things have remained the same. So Nifty is trading, above its key moving averages, whether it is the 50-day moving average or the 200-day moving average. That holding pattern above these moving averages is a positive technical setup. The relative strength of the Nifty, or the RSI as we all call it, has also improved recently. So as of yesterday, I think it was around 58. The daily RSI, weekly RSI was around 60. So the relative strength index has been improving for the Nifty index. India VIX, the thing is, we're seeing it at lower levels. 12-13 is where the India VIX is, which means that at least it's back to its calm zone, and we're not really expecting any major ups and downs as far as volatility is concerned, at least for the time being. Now, FI flow, that is the money direction. So the June segment, at least the sell figures have stopped. VIX has come down. Now essentially we're seeing early signs of FI sort of thinking on 2 lines. Now, if the earnings are not a disappointment, we may very well see these FI flows turn positive post the Q1 numbers. But even if the earnings are a bit disappointing in some sectors, we may see some bit of course correction that may happen in the stocks and sectors, post which I think from somewhere from September, October, we may see a structural recovery happening in the market. So like I said in the very beginning, the outlook for the market is this could be that last leg of volatility that we may see at a broad index level. The Q1 numbers that come, they may be a price shakeout. As and when they happen, this could be a brilliant buying opportunity for the next 6 months time frame. We believe that by the end of this year, Nifty may very well be at 27,000 plus, which means a new all-time high is very much on the cards. Now, there are 2 reasons for it. One is, obviously, the FI aggression coming down on the back of globally things improving in terms of the geopolitical thing, oil remaining below. So we know that story. But what has also happened is globally, whether it is US markets or European markets, fresh opportunities are not really present in these markets. A lot of these positives are already factored in. Last 2 years, US markets have enjoyed a brilliant bull run. We've actually stayed very sideways. So in case we do see either the monsoon picking up or the Q1 numbers being relatively better, if they are, that would ring a bell, and we may very well see the markets turning around and the recovery extending its way towards 27,000 by the end of this year. So this is the view that we hold for the market going ahead from here. Short term, a bit of volatility is very much on the cards. But in the medium term, which is 6 months time frame, we feel that we have a good upside to be had, and markets should do well from here. Now, simply put, when it comes to trading in this kind of a market, goes without saying, trade only what makes sense, and always have a 1:2 kind of a risk reward. Although these are very basic things to follow, but what happens many a times is when we trade, we tend to miss out on the basics, and basics done well is what makes a good trading plan. So always trail your stop losses, protect your profits once you have them, and eventually, market doesn't reward bravery, market doesn't reward, any other emotion. It rewards discipline. So request everybody to please keep your lines on mute. Okay, so these are the basics that one can do to sort of navigate the market from here. Now, what we are also seeing, apart from what is there on the slide, we are also seeing sharp sectoral rotation happening from time to time. So we've seen that Nifty not going anywhere. We are still around that 24,000 mark. If you see last 2 years, Nifty has essentially stayed broadly where we were last 2 years ago. But in between, there have been a lot of swings between sectors, and we've seen money moving in and out of different sectors. So smart sector rotation should be the key going ahead into this kind of a market. Unless and until a structural recovery begins, I think the asset allocation will play a big role in terms of managing your portfolio in the time to come. Now, lastly, which are the things that you have to remember from this deck? So the number one is the crisis has de-escalated. The recovery has already started. We may see, the markets markets are already reacting positively to it. Maybe 24,500, 600. There could be a bit of resistance. Look to book profits around those levels. Wait for the IT numbers to come in, which starts next week. Initial set of results will set the tone for the market as to how we are positioned and how do we go from here. Overall, it will be key to watch how the RBI policy is in the first week of August. Maintain risk rewards at a healthy level. Unless and until you don't find a good risk reward, it's better to skip the trade rather than take those trades, take that risk. Financials, auto, defense, and pharma. These are the sectors in this order which have been leading the market, have shown strength, and eventually technical signals for the Nifty are also getting aligned as we've shared in some of the charts that we've shown today. Crude oil from here and FII flows are the two most important things to matter from here. Knowing Mr. Trump, he can go back on his word. There could be another round of volatility. We don't know. So the best indication is as long as crude remains below $80 per barrel, that should be positive for us, which means RBI gets the room to cut rates. Otherwise, it's best to look at also the FII numbers in case they turn out to be buyers, on a consistent basis, at least for 2 to 3 consecutive weeks. That would, put us in a very strong position. So, like it is said in markets, the best opportunities don't come announced. They are generally disguised as a crisis. And, the crisis is failing, and probably the opportunity that we all been waiting for probably could be in the next 1 month or so. So for the next 1 month, keep your eyes on key support levels. Nifty 23,800, 23,500 and 23,000. These are the 3 most important support levels to keep an eye on. 23,000 is literally the base for this entire recovery that we've seen, followed by 23,500 and 23,800. Look to add on to dips around these levels, and eventually we feel that if you stay the course and stay patient in the market, the Nifty, especially large caps, should reward. Large caps haven't had their rally so far. We feel the large caps should play catch up. We already saw mid cap index doing very well and hitting a new lifetime high even before Nifty did. But this time around, I think the large caps have a fair chance. Hopefully, towards the September-October period is where we see a structural recovery happening in the market. So that's it from my side. We can now open the floor for Q&A. In case you have any questions and queries, feel free to ask. Yeah, so IT sector, it's better to be a trader over here. The last 2 days, we're seeing a bounce back happening in the IT space, but the overall structure still remains that of a lower low and a lower high, and we are continuously grinding down on this space. So unless and until there is a fundamental change that happens, now the earnings which start next week could be a trigger, but having at least the price is not excited much about it as of now. So unless and until there is at least a couple of months of consolidation that happens in the IT pack, it's best to take it with a pinch of salt and look to these bounces as and when they happen, look to reduce them on these bounces, and once the consolidation happens, probably then we can think of a reversal of a recovery. As of now, it's still in a very much a downtrend. Yeah, that's a very interesting question. It's important to have, 2 portfolios in this kind of a market. Now, last 2 years, long-term portfolios haven't really made money. It is the short-term ones which have now, because simply put, because the volatility has been there, providing opportunities time and again. So, let's say you have 100 rupees invested in the market, have about 60 to 70 rupees invested in the long-term side of things, about 30 to 40 rupees can stay invested in the short-term side of things. We come out with baskets at regular intervals, short-term investing basket, which can be considered. At the same time, there are sectoral shifts that happen from time to time. Even that is one play that can be looked upon from a tactical perspective. So have a split between both of them, and over a period of time, eventually both will catch up. As of now, it is the short-term side of things which are doing well, but we feel that even the long-term investors should, eventually reap the profits probably towards the end of this year. So generally we look at least 2 or 3 markers when it comes to identifying reversals. So one of them is generally the divergence of price and momentum. So if, let's say, the price is after a big correction, the price has started consolidating, or rather the price is sort of slowed down on the speed at which it is falling. It's like a first indication of the ship is about to turn. And if you combine that with something like an India VIX or the FI long short ratio, or if you combine that with any of the key indices, like for example, Bank Nifty was the index which was very early to recover in this market. So leadership combined with divergence on the markets, combined with positioning change, whether it is FIs or whether it is derivative positioning. If any of these 3 happen, at least 2 things happen out of 3. If 3 things happens, even better. But even if 2 things happen out of them, we can very well take a call and say, okay, there's a high possibility that the markets may reverse from here. Frankly, we've missed out the small and mid-cap bus, when it started in terms of the view on the market. But yes, I think the time is right now for a bit of catch-up, especially on the large caps. But, because the Q1 numbers will be beginning next week, which is why we advise a bit of caution and advise to buy in dips rather than buy at these levels. So, these geopolitical crisis is more like an earthquake. So when an earthquake happens, the immediate reaction is panic. And then what happens is, over a period of time, people realize that, whatever is saved, let's rebuild and, start afresh from there. Something similar is happening in the market. Once the crisis hit us, it was panic all around. Now, we are in that process where people have started recovering and rebuilding things from the scratch. And that's, very similarly it is happening in the markets also. Now, obviously the bill will be raised. The bill is the Q1 numbers. So the mark sheet will have a, B or maybe a C when the mark sheet comes in. And, that would be one reason for the markets to react negatively. But after that is done, after that is completely digested, I think that is when markets will start looking forward and ask questions as to how many rate cuts are possible this year, what kind of global equity outlook now exists, and from a perspective where global markets are here, India is here, and if fresh money has to come in, that money, there's a high possibility that money comes to India because of the major underperformance that we've had over the last 2 years. So my view is geopolitical scenario is behind us. Now the focus will be on the leftovers and rebuilding phase from here.
What will yes,
that will take time. So that will take time. That is why the view that September, October we could start seeing a structural move in the market. Until then, we may just spend some time base building, maybe moving back and forth, maybe for a couple of months more. And post that, we should see some bit of proper recovery happening in the market. So yeah, that will take some time. यस सो रिजल्ट्स थोड़े से पेचीदा होते हैं. तो रिजल्ट्स में होता क्या है कि मार्केट्स एक एंटिसिपेशन करके चलता है कि रिजल्ट्स खराब आएगा. अब लेट्स से खराब में यानी कि -20% आएगा ईपीएस और लेट्स से -30 आ गया तो मार्केट जल्दी ज्यादा रिएक्ट करता है. एंड इसलिए -15 आ गया तो पॉजिटिव रिएक्ट करता है, हालांकि रिजल्ट्स कमजोर है. सो मार्केट्स ने कितना प्रेडिक्शन करके रखा है अभी तक उसका अंदाजा हमें अभी तक नहीं है और किसी को भी नहीं. इनफैक्ट तो जो पहले सेट ऑफ रिजल्ट्स आएंगे हो सकता है कि एक दो सेक्टर रिजल्ट्स आने के बाद एक आइडिया आएगा कि ओके व्हाट इज मार्केट एंटिसिपेटिंग. तो समवेयर अराउंड एंड ऑफ जुलाई और मे बी थर्ड वीक ऑफ जुलाई वी विल हैव एन आइडिया क्योंकि दिस इज व्हाट द मार्केट इज ट्रेंडिंग, इमेजरी ट्रेंड इज इवॉल्विंग. सो अराउंड दैट टाइम वी विल बी कमिंग आउट विद द बास्केट और वो बास्केट आप अपने क्लाइंट्स को रेकमेंड कर सकते हो एंड इस बास्केट पर काम किया जा सकता है. तो यस वी आर वर्किंग ऑन इट एंड वंस वी सी द इनिशियल रिएक्शंस फ्रॉम द रिजल्ट्स हमको भी क्लैरिटी और आएगा और साथ में एक डायरेक्शन डेवलप करने में हेल्प करेगा. So the simplest method is let's say Monday market starts and let's say Monday it is 2 p.m. So Monday is fresh day of the week. So generally how we do it is the directions or the leads sectors which are leading on Monday are generally the sectors which probably may lead for the week as well. So there is a probability. So same way for the week whether one sector is going to lead that is given by what is happening at in the first few hours of trade on a Monday morning. Same way if we do historical analysis we do it on a monthly scale. So let's say the month of July has just begun. Which are the top 3 sectors which have seen buying happening in the first 3-4 days of the month? These are the ones which generally do well from a momentum perspective. So generally the comparison between laggards and leaders based on what time frame that you track it. It could be an intraday trade, it could be a weekly trade, or it could be a monthly trade. Yeah, so from a consumption perspective, especially the festive period, we see festive demand coming back if the monsoons are good overall. But this time around, because of the El Nino effect and everything, there is a possibility that the monsoons may be maybe 50-40% lower than average. So the best thing is to wait it out and see how it plays. But most often than not, when it comes to consumption, like you can just Google consumption-related stocks in India. You'll get a list of stocks. Like to give you some examples, it could be stocks like Titan, stocks like Indigo, stock white good companies. It could be tractor-related companies from the agricultural side. So there are a lot of stocks which sort of come under the consumption umbrella, but that is subject to a couple of things. One is the monsoon being normal, and second is the oil sustaining where it is right now. So once these two things are done, we'll have more clarity as to whether we should take that bet or not. As of now, it is to be kept on a wait and watch. Yeah, that's a very interesting observation on the monthly charts of both the indices. Now, just to FMCG was more of a defensive play in that period, and it hasn't really got a trend to undermine it before the crisis began. So, sort of it's more of a low conviction trade as of now. But reality, on the other hand, if you see, there are two things to it. So one is it was already in a bearish undertone even before the crisis began. So after we hit the high in July 24, the realty index has been under pressure since many months now. But if you zoom out and see last 15-year, 20-year kind of a chart, there is a big rounding bottom formation that has been formed over the long-term structure, and we saw that big up move happening in 23, April 23 to July, August 24 is when we saw the big vertical move happen in that. So that move has completely retraced itself and the bottom that we're talking about that happened in March was actually a completion of that retracement. And now I think it is set and poised well to do much better from here. So my sense is, it is positioned very well, but it is a high beta play. The normal swing comparatively, the swings are much wilder in the realty stack. But from an long-term investment perspective, I think the realty index has turned around and it has got long legs if you have like a 1 year plus view from here. So, direct AI plays in India are, hard to find. There have been stories and, basically people are trying to link them up. The ones who are actually doing business in AI are the ones who are service providers at the end of the day, whether it is Infosys or TCS. So, yes, the direct AI core play is missing in India, and that is one reason why we've seen outflows happening in India. If we really had something on the AI engine, it would have been a totally different story in the last 2 years time frame for our country and for our equity scenario. So yes, that is to be seen. But from a domestic consumption space, things are still very solid for us. Whether it is auto manufacturing, a lot of things which are inward looking are still doing well for us. And as far as IT sector, we already shared the view. And as far as the IT boom is concerned globally, I think that bubble may burst, at any point in time. When it bursts, we don't know, but when it bursts, it will bring in a lot of, dominoes along with it. Thanks to each one of you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.